show. Today we have Alden coming with us today and going to speak with us today. Nice to meet you, Lynn.
You as well. Nice to
Hi.
meet you.
Nice to meet you. So, can you give us an introduction about yourself and just who you are and what you do?
So my background is a blend of engineering and finance. So I used to be an electrical engineer and then shifted into electrical engineering management, and then kind of overseeing the finances of an engineering facility, kind of multidisciplinary, focusing on aviation simulation. I eventually left that to focus on investment research and kind of the gap, the way I bridge that gap is I focus a lot on kind of systems analysis for the markets, like how the monetary system's structured, some of the kind of just the overall structural things in the market. So that kind of macroeconomic focus from a systems background. And then, in kind of recent years, in addition to providing investment analysis, I've been active in research for Bitcoin. And I work with Ego Death Capital. We do some Bitcoin related VC work. And just other kind of startups type of work in the space.
Okay, so is it accurate to say that like in 2020 we had this huge surge in money printing, and now we're trying to curtail it? Right now, the Fed is raising interest rate, and the government's supposed to be, stopping to spend money, but they're continuing regardless, and that has bad consequences. Is that correct?
Yeah, that's correct. Basically, so in 2020, there was that combination of fiscal and monetary stimulus. So basically, rather than, the past decade, a lot of the money printing we saw was mostly kind of stayed in banks, right? They increased the base money to prevent kind of deflation and bank failures, but they didn't just send tons of money to people. Whereas in 2020, they directly sent money to people, but in order to afford all that bond issuance without kind of choking out the markets, the Federal Reserve just created more base money to buy those bonds. And so that's outright money printing, quite inflationary for asset prices and for consumer prices. And now they're trying to rein that in by tightening their own balance sheet, by raising the cost of capital. And the challenge is that like you said, with the fiscal deficit still going on, but just no longer being monetized, but still happening, it's kind of crowding out the private sector. Like basically the Federal Reserve's, their tools are not really designed to deal with fiscal deficits. They're mostly designed to deal with the rate of bank lending. So they're primarily focused on, kind of reverse wealth effect, suppress bank lending, to kind of slow down money supply growth from that angle. And it is being challenged by how much fiscal activity is still happening.
And that matters because the banks are lending and are kind of in charge of economic activity. And right now the Fed is telling them do not create any more money. Is that right?
Yeah, so they don't directly control the broad money, but they have these various ways to slow down or accelerate bank lending. And by raising the cost of capital so much, it makes borrowers a lot more hesitant to borrow money, or unable to afford things that they would have otherwise done. And so that in theory slows down bank loan growth, and that's what we have been seeing. They've been slowing down the rate of bank loan growth, and then they're also doing quantitative tightening. So they're selling bonds back to the market by letting them mature, and then instead of reinvesting those, they just basically delete that cash, and then the private sector has to buy kind of the reissued bond.
So TLT right now is kind of an ETF of all the bonds, and I'm assuming it's just like a leveraged fund, but it shows that it's taking quite the hit, and it doesn't look like there's many buyers. This is ultimately going to have to be the Fed that comes in, or can they raise like Basel requirements or do something with the banking sector to force them to buy debt?
Well, so the shocking thing about TLT is it's not levered. That's literally just treasuries. The reason it's so volatile is those are very long duration treasuries. And so if a very long duration treasury goes from 1% yields to 5% yields, for example, that means the price has gone down significantly. And right now, the Fed doesn't really have to do anything about it. I think the issue kind of starts maybe next year, where this rate of treasury issuance is still going to keep happening. And I think eventually they're just going to be unable to keep tightening their balance sheet. It's, kind of like basically the limiting factor is that if the treasury market goes illiquid, that's generally when the Fed steps in, right? So right now, the Treasury market, even though the prices have gone down significantly and the yields have gone up, the market is still functioning. There's no problem with Treasury auctions. There's no problem with like the secondary market seizing up in the way that it did, for example, in March 2020, and in a way that the repo market did back in 2019, and the way that the gilt market did, the UK bond market did back in about a year ago in kind of autumn 2022. As long or until those conditions happen in the Treasury market, the Federal Reserve is able to kind of keep their tightening effort up.
Okay, so if the Fed is purposely constricting everything, and what you're saying is eventually that the markets break, well, that where they have to actually step in. Do you see this as like more of like a deflationary crash that has momentum behind it, like 2020 or 2016, or do you see this more as inflation?
I view this as a disinflationary cycle within like a longer context of inflation. And so I don't really see it as necessarily, I don't necessarily see it as a sharp period of disinflation, because with this much fiscal deficit still pouring into the market, like $1.7 trillion in annualized deficits, it's pretty hard to have a deflationary shock. Now, I think certain parts of the economy can, like commercial real estate, and that's kind of already happened in some aspects. But basically, it's like two powerful forces hitting in opposite directions, which is a little bit different than some of these prior deflationary shocks. So I see more of like a stagnation, but it's something I keep monitoring, because there are a lot of things here that are either unprecedented or not seen since like the 1940s in terms of the macro environment.
Right. And there's a bunch of geopolitical risks that are happening right now. And do you think that's going to affect the markets broadly?
That will depend on to what extent they break out. So if anything disrupts oil, for example, Iranian oil, that would certainly have a major effect on the market. Even the heightened risk that oil could be disrupted already results in higher oil prices, at least temporarily, as investors kind of change their probability assessment of oil supply security. Apart from that, war financing is another additive for deficits. It also basically ensures that like defense spending is not going to be going down. That's not one of the measures they're going to be using to reduce the fiscal deficit. And so I think it's just like a small thing that adds to the existing issue, and with always like the risk that it could grow.
Yeah, and oil looks like it's got some momentum behind it. It's catching a bid. Do you think if oil continues to expand, that will put a wrench in the works for trying to curtail inflation?
Yeah, so I'm a long-term oil bull. Kind of when I look out the next 5 years. Ever since kind of the COVID crash, I've been kind of very constructive on the oil markets, especially as we saw a real recovery by like 2021. And basically, there's a supply side limitation. There's just not been a lot of investment in the supply side, and there's only almost all of the marginal growth has come from U.S. shale, and that is basically it depletes very quickly. You have to keep drilling in order to maintain the rate of production you have, let alone keep growing it. And a lot of that's kind of reaching, not maybe its high point, but it's closer to the high point, I would argue, than it is kind of at its starting point. It's now a mature asset, at least in this kind of technology cycle. And so I do think that energy inflation is going to be an ongoing risk. Now, the next 6 months is very unclear, because you have to pair that with the possibility of demand destruction. If you have very tight interest rates and you're trying to slow the economy, and not just the US, but also China, Europe, that can eat into oil demand. But longer term, I do think that energy prices are going to be a problem. And if they go up significantly, that eats into other things. And, the way I would kind of phrase it is, when we have a macro environment like we have now, stocks and bonds tend to be more correlated. So instead of being like the inversely correlated assets they used to be, they're now more correlated. And I think in some ways, energy is the hedge for other types of risk assets, which is energy can do well when other things are doing poorly, and energy can do poorly, which allows other things to do well. And so I think that's a useful portfolio diversifier for people.
Yeah, I mean, I was listening to Christine Lagarde and kind of all the central bankers at a Bloomberg summit. They're pretty much their stance is to blame the government for spending too much. We're at a point where the physical deficits are too high, and I mean they basically do the same with the OPEC, right? As soon as energy starts getting higher, they start pointing the finger at OPEC. Do you think there could be a disruption with OPEC, kind of like what we saw with 2020, where somebody just backs out of the OPEC plus and just backs out completely?
I mean, so it's possible. I mean, in some ways they seem more unified than they have been in a while. They're already not even meeting their targets. So normally the history of OPEC is that they set kind of quotas, and then countries in some ways try to overshoot a little bit, like kind of cheat a little bit, and produce a little bit more oil to kind of capture that, because it's kind of like a tragedy of the commons type of thing. If you can cheat a little bit and get away with it, it's the optimal kind of solution. But in the recent environment, a lot of them are actually undershooting their quotas, because they have a similar problem with shale, not in the sense that it's a fast decline rate, but in the sense that a lot of them have, for the amount of capex they've put in, it's hard to get a lot more oil out. Saudi Arabia has spare capacity, but I would argue that the other ones are kind of tight. And so I think in some ways, that's less important, and it's more important about what Saudi Arabia does. They're kind of the fulcrum there, in terms of they can affect oil markets, whereas the organization as a whole, I would consider somewhat less influential than it was, decades ago.
I didn't get a chance to read your book. So your book is called Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. I haven't had a chance to read it yet, but it's on my Amazon list. I look forward to reading it. Is this tie in the whole adjunct of blockchain technology and everything? So the fiat system is breaking, and blockchain technology is a way to increase settlement times and kind of enhance the banking system to a point where fiat is no longer really needed, or modern day banking is no longer needed.
Yeah, so the final third of the book does get into Bitcoin, stablecoins, central bank digital currencies, and some other kind of adjacent technologies, and how they kind of fix some of the problems of legacy systems. Kind of the big framing I focus on is that due to the big gap between transaction times and settlement times, for the past like centuries, especially since the creation of the telegraph, which really widened that gap even further. But for centuries, almost every solution for fixing that gap is centralization and credit. So basically we say, okay, we're going to let this big entity, nowadays it's a central bank. It used to be other banks, but basically you say, okay, we're just going to use the ledger of the central bank, and that's going to be our way to kind of bridge this gap. And so of course that centralizes power. So for all the increasing speed and efficiency we've had with our system for centuries, the trade-off has been more and more centralization. And kind of the invention of Bitcoin represents the first real shot at reversing some of that. It's basically saying you can have the fast speeds without the centralization, because now with the internet, now with distributed technology, you can do that in a more decentralized way. And I think the biggest disruption is that there's like 160 different fiat currencies. Some of us are lucky enough to have the dollar or the euro or the yen, which are, they have their own problems. But a lot of people have the long tail of way worse currencies, ones that have virtually zero acceptance outside of their own country, ones that degrade a lot quicker. I spent part of each year in Egypt. They have 20% annual money supply growth. You can't really use the Egyptian pound anywhere outside of Egypt. And the way that these currencies maintain themselves is that because there's not been another way to move money quickly, they've been able to build their little monopolies that all tie into the dollar super monopoly. And they basically have financial firewalls around their borders. And so we don't really have globally portable capital. And it's hard, for example, it's purposely hard for an Egyptian to get dollars. It's hard for them to buy S&P 500, for example. If you're wealthy, you can do it, but it's, the average Egyptian or the average Nigerian or the average Nigerian. And so we've had this kind of siloed effect for a very long time. And I think the most powerful thing about Bitcoin and then other things like stable coins, tokenized assets more broadly, is you can say, okay, here's a global asset that you can have on your smartphone, either something decentralized like Bitcoin, or saying, look, if you want to hold dollars, if you want to hold T-bills, here's a mechanism to do that. And it's kind of like an offshore bank account for the middle class. Basically, technology makes that more accessible, more automated. And that really, I think, in the long term, um, uh, has a really good shot of disrupting these 160 different currency monopolies that people are just born into. And if they get unlucky, meaning they're like in the long tail of like the billions of people that live in bad currency environments, um, their choices are very limited. And I think this is going to open their choices a lot.
Sure, I agree with that. I mean, just being in a different country, not being able to have the access to financial assets and being able to, I mean, be able to learn code and actually bring yourself into an ecosystem that pays developers and gets work, right? It's kind of an amazing opportunity in itself. So the idea of like fast settlement times, like that was kind of what they were blaming Silicon Valley Bank on, is like people withdrawing their money from the bank account too quickly, and this is kind of ushered in crypto regulations to an extent, right? They keep talking about Silicon Valley Bank, and then now they're pushing for different collateral requirements. MiCA came across in the EU, and they're pushing forward with different crypto regulations. Do you think that this could be a tool for governments to enhance the grip on their citizens if everything is surveilled and KYC'd and AML'd? I really have no privacy, and then Bitcoin's a transparent ledger.
So yeah, I do. I'll break that into a couple parts. One is that I do think that the faster kind of transaction times out of banks is relevant, and it threatens fractional reserve banking in general, or at least increases the liquidity requirements that banks have to have. In a world where investors can just pull out $40 billion with an API. They don't have to go to the physical branch. They don't have to get someone on the phone. It's all automated. They have to basically, the probability of bank runs at any given moment is higher now, so there has to be more liquidity or more tools to handle that. Because fractional reserve banking is inherently based on the instability in the sense that they make promises of liquidity to depositors. They say, look, you can all anytime within banking hours, or now sometimes 24/7, you can pull money out. But we're only going to have a percentage of that in liquid form, and the rest is going to be in illiquid assets. And so you're kind of double counting your liquidity. You're kind of hoping that probability holds. And if there's any reason why it doesn't for one day, the bank can fail. And faster pullout times make that more probable. Now, in terms of crypto regulation, I think that it basically, if we step back for a second, the Western world's in basically a sovereign debt crisis in the sense that they have very, very high public debts. And generally when they get to that point, they're not going to default on those debts. So they generally have to inflate it away, have people hold it while it kind of fails to outshoot inflation in the long run. Right now, the central banks are kind of objecting to that, but that's kind of how these things normally work out. And so they normally turn to financial repression, trying to block the guardrails, silo things as much as possible, control what people do. Like in the 1930s to the 1970s in the U.S., it was legal to own gold. They basically said that's an open ledger that we don't like. It's a harder money. It's like this open thing that we can't control, and we don't want people fleeing to that ledger. We want to keep them in our ledger. And so they would do things like that. So I do think that there will be various kind of ongoing regulations to try to control and silo this technology as much as possible to launch their CBDCs. And I think it's on us to be kind of, mindful of that, and to, one, educate people about how this works, two, keep building better solutions that are harder and harder to control, because if it is controllable, it will be controlled. If it's not controllable, then they won't be able to control it. And I think that's kind of the big race here, is that they want to silo things even more, and open source potentially breaks all those silos. And Nigeria's been interesting because they've launched the CBDC, and it's not been very successful. They've had very low adoption for a long time. They managed to get adoption up a little bit by really restricting cash, but then they got riots. The central bank governor ended up getting arrested, and more people in Nigeria hold things like Bitcoin and stable coins than they hold the e-naira, right? So it shows that, Nigeria is not every other country, but it shows that, a CBDC launch is not like a guaranteed success story. If they don't have control of their ledger, if they have high inflation, if they have problems, if they're blocking transactions, people will try to flee to better monies. And so I think that the technology has to be good enough that people can do that, and they will use whatever excuse they can. Like, for example, Argentina, which I think currently has like 140% official CPI inflation. They, like in 2022, they said, okay, banks can't send money to crypto exchanges. Then in 2023, they said fintech companies, payment apps, they can't do it. They cited, money laundering, instability, blah, blah, blah. But of course, the real reason is because they want to slow down the exits from the peso. They want to add frictions. And you generally don't see countries that are doing well block the exits. That's what they do when basically the barn's burning down, they lock people in, currency wise. And so I think they will keep trying that. They will always have they're never going to say, our currency's bad, so that's why we're going to lock you all in. They're going to say, look, speculators are attacking our currency, so we have to do this. Or they're going to say, crypto is bad, so we have to restrict it. That's the kind of messaging they will generally do to try to keep their ledgers in order.
Yeah, I've been hearing a lot about like the euro dollar system, the utility of the dollar being a lot stronger than people really anticipated to be. The dollar has a lot more utility than that. Can you speak about the euro dollar market or the dollar's utility?
So the dollar, money is a network effect, and the dollar is by far the most liquid, furthest reaching, largest, deepest capital markets, money out there. And debt represents demand for currency, right? So there's 13 trillion or so in offshore U.S. debt, dollar denominated debt. And then the unintuitive thing is not even owed to the U.S. for the most part. Like, a country in Latin America will owe dollars to China, for example. So both the borrower and the lender are not necessarily American, but it's dollar debts. And every dollar if you owe something, whether it's dollars or euros or whatever, but in this case, dollars the most, is you have inflexible demand for those units. And so there's basically $13 trillion in demand worth of $4 offshore, plus all the domestic demand $4 based on just the fact that all these debts exist. And all of those, or most of those, are interest bearing, which means the demand only increases over time. And there's far more debt than there is money, which means you can never pay off those debts other than by printing more money over time. And so there's kind of this inbuilt deflation mechanism in the system that always pushes back against the inflation. And that's why emerging market currencies tend to inflate or even hyperinflate a lot quicker, is because there's almost no external demand for the currency. There's not a lot of debt denominated in that currency. And so when they increase the supply very quickly, there's no offset. You're just printing monopoly money. Whereas when you have a very established money, and there's a lot of debt denominated in that money, especially globally, that system is very reinforcing and has long staying power. Now, I think that in the long arc of time, network effects can still be disrupted. It takes decades instead of months or years.
Yeah, I listened to one of your podcasts and you're talking about the idea of a reset, and you're like, this isn't a conspiracy theory. This is actually, how it ends. And I think people have kind of grown immune to the word reset or any type of financial reset, but historically it's always happened, right?
Yeah, because reset's a charged word. It means different things to different people. I think another phrasing would be recapitalization. That's kind of a euphemism, which is to say that basically when the banking system or the sovereign itself is overstretched, they can recapitalize, meaning that they do a sharp currency devaluation, they clear debts away, and they reset more towards equity. And so I think that's kind of the outcome we're seeing. Just it's a long-term process. It's, these things can be punctuated by major moments of history, the global financial crisis, the 2021 stimulus, the US cutting Russia off, freezing reserves along with Europe. These are kind of things that get put in textbooks as like the moment where like a pivot happened. Of course, if you go back further, it's like, the 1933, like, bank recapitalization, gold revaluation, gold ban. Those moments are kind of the pivot points where things happen, but it always ends up being a multi-year, in some cases multi-decade story. So if you go back to the prior recapitalization, it really went from like World War One all the way, past World War Two. That was kind of this whole period where it happened, and it happened at somewhat different times in different countries. And I would say that the current period is happening ever since the global financial crisis, and then probably extending into the 2030s. Although, of course, that's, you can only see out so far, and we have to always deal with information that kind of comes in.
So are you only interested in Bitcoin, or are there other protocols that you're interested in?
So because money tends to be a network effect type of good, and liquidity kind of contributes to more liquidity, and because I consider decentralization the key thing that I would optimize for in a blockchain money, Bitcoin is the one that interests me from that angle. The other area that's been interesting to me is stable coins, or the broad idea of tokenized assets. So it's basically saying that, you don't need to be as decentralized as Bitcoin in order to say offer T-bills to anyone in Nigeria that wants to buy T-bills. That it can be pseudo centralized as long as that central hub is not in Nigeria. And so there are use cases, I think, for making real world assets more globally available to people. And so that's what I would consider kind of the second killer use case, after Bitcoin.
Yeah, it's almost like hyper efficient bartering to a certain extent when you start like tokenizing all the real world assets. I know Stellar Lumens is working with Franklin Templeton to tokenize T-bills and different money market accounts. So they're putting them on chain. So where can we find your book? Where can we find you if we want to learn more about everything?
So Broken Money is available on Amazon. You can also go to lynalden.com and see kind of the research work I do. I have a free newsletter. People can check that stuff out.
Well, thanks, Lynn. I appreciate you coming on the show and sharing everything that you shared. It was great to have you, and look forward to see if you ever come back.
Thank you for having me.
Thanks. Thanks, everyone. I hope you enjoyed the show. Please take a moment to like and subscribe. If you enjoy content like this, please consider joining my Patreon or my Ghost site.